Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. The recent fall in the value of debt funds has raised a lot of nervousness amongst the investors. What's the way out? Should they stick to the traditional way of investing in fixed deposits? Well, all these questions will be answered by the CEO of Value Research, Dhirendra Kumar. Dhiren, we welcome you.
Thank you.
Recently, as I said, the issues about debt funds are coming to fore, and the investment value is eroding.
Yeah.
So, is it safe to park your money in the debt funds for short-term goals? And before that, what exactly happened? Why is it so?
No, it's important to understand that how debt funds work.
Okay.
There are different kind of debt funds with different orientation, and debt funds invest in bonds. Debt funds invest in fixed income securities, and bonds have a very precise design that it has a maturity. That it's almost like a deposit. You are buying something which will expire on a certain day. Till it expires, it is yielding a return, so it could have a 7%, 8%, 9%. The issuer of the bond will pay that, so it is his obligation to pay that. And then the quality of the bond. There are credit rating agencies, and it is mandatory for all the bonds in which mutual funds invest. They must have, except for the sovereign bonds, except for the bonds issued by the government. All other bonds must be rated before mutual funds can invest in them. So the credit rating agency gives you an opinion on the quality of those bonds. So what you come across as a AAA, AA.
Okay.
So AAA is the highest quality. AA is a notch lower, and so on and so forth. And it slips down to something which is default grade, or not an investable grade rating. So mutual funds choose to invest in these bonds, and they build a diversified portfolio of bonds. They try and mix it up in a manner that there is a reasonable sense of, there is a reasonable mix of liquidity. There are bonds which are always traded. There are bonds which are not frequently traded. Then high quality, lower quality, mix of it, so that because the lower quality bonds enhances the return, they yield more return.
Okay.
Highest quality bonds, they yield lower return. So if you just have highest quality, then the return will be lower. So, and they try and have a maturity profile of the fund, which is dependent on the kind of fund that they are managing. So you have the liquid fund, where the funds are not allowed to invest in securities which has expiry or maturity of more than 60 days. So that is where, and the valuation of all these bonds is done on a mark-to-market basis for securities which are over 1 year old. For less than that, it is marked based on, the worth of that security, because it's about to expire. Even if you hold it for 60 days, the worth of the bond is pretty close to its face value, or if there is an interim payout. So you just do it on a YTM basis, yield to maturity. So what happened was that mutual funds have these set of bonds in their various funds, and one of the bond which they had, it defaulted. It was a very high INFS. And this is something which happened in other bond funds too, but it was not that alarming. It happened in August 2015 with Amtech Auto. It happened on a few other instances too in the past, where fund companies were able to deal with it, and it did not happen. The most alarming thing that has happened right now, and it has actually shaken investors' belief in a kind of fund which investors tend to expect that it will never go down in value, the liquid fund. These funds these are ultra safe. There has never been an instance before this situation, this example, this instance. In the past, in last 21 years, ever since the liquid funds were started with Birla Cash Plus, they never fell in value on an overnight basis. Every day, no, to any extent, they never fell in value on an overnight basis. So the NAV always went up or remained constant. It never went down in value. Only one exceptional value, situation that it went down in value sometime in 2011 for one fund. So the liquid fund going down in value this is alarming. This is something which investors were not prepared for, and I think it can entirely be attributed to the credit rating agencies, because the bond flipped. One fine day the bond was downgraded to a default grade, or a grade, and the rating itself determines the valuation. So that day itself every fund faced this decline in value, because there's a valuation matrix depending on the rating, depending on the solvency, depending on the maturity, quality of bonds, and so it gets valued. And there was a default. ILFS has not been able to pay the principal and interest on time. So that's the start of the story. But here it has shaken belief in the liquid fund. Other bond funds, investors are used to it. Investors have experienced the kind of decline, and there was no hue and cry. When investors try and time their entry into a dynamic bond fund or an income fund, and everybody was expecting that interest rates will go down, and we got a surprise that interest rates went up. Every bond fund declined in value, and 2 to 5% decline in value wasn't very alarming, because people were used to it. They could have got an upside, and they got a surprise downside. Liquid fund is alarming, and I think not much can be done about it. I look at it more like, should investors run away from liquid fund? No. I look at this example or this situation or this instance as a one-off thing.
What's the reason for your confidence that one should not run away?
Reason is that one, it's a one-off thing. It has not happened
As you
before.
said, 21 years.
21 years, nothing happened. So I would say that it can happen again. I'm not saying that it cannot happen. It is one-off things can happen, but I don't think it is going to become a routine.
Okay.
Also, I feel that liquid fund after this situation will be extra careful, because they were, and there are the liquid fund which were not able to visualize this. There are funds which completely escaped this problem, and there are funds which were very much in the middle of it. So this will actually drive a lesson in terms of how to manage risk better, particularly in liquid fund, where investors tend to expect that it is ultra safe.
Okay, you just made a comment that liquid funds will be extra careful. So how will they be safeguarding themselves?
Avoid higher yielding short-term money market instruments.
Okay.
Because I think it is entirely a result of fund managers getting greedy to give superior return to investors. And by now they would have realized that it may not just be worth it. It may not be worthwhile for them to attempt to generate higher return, because what you get is maybe 25 basis points more. But the erosion of capital is something which is not negotiable, and it should not be negotiable in a liquid fund. So they should not get greedy. They should not try and maximize return. Conservative approach to managing liquid fund is important. But all that we are saying is it is a doomsday. When I look at the mutual fund design and structure and what has happened to investors' returns, it looks like somebody has walked away with money. Yes, one company has defaulted in repayment of principal and interest. But look at 1 month return. Taking this situation into account, your return is lower. You have earned 0.5%. You are expecting that you will earn 7.75%. So it is not that your that particular day, overnight basis, decline in value was alarming. We were not used to it. But on a 3-week, 4-week basis, I think investors haven't lost anything meaningful. Investors haven't lost money. They should not have lost anything, even on an overnight basis.
Okay. So this question about them moving from short-term investment to bank fixed deposits as a guarantee for preservation of their capital, will that be a right statement to make?
No, I think deposits are medium term, long term, and if you need to invest your money for a couple of days, couple of weeks, or few months, liquid fund or ultra short term bond fund will still be the better way of because you get more tax efficient return. You get higher return, you get superior liquidity, not necessarily tax efficient on the short run basis.
Okay.
In the short run. But that apart, I think I would look at it more like an accident and don't think of it as the norm. I don't think bond fund investing in bond funds is dangerous or risky. Yes, it is something which was unexpected. It's an accident, and look at it exactly like that.
Okay. So is there any checklist that an investor can look at, okay, while investing in debt funds to avoid such situations? I know you said it has never happened in 21 years. So, but going forward, मेरे alarm bells कब ring होने चाहिए?
I think investors can do only two things. One is one which will work very nicely, particularly in liquid fund and ultra short term bond fund, that never buy a higher yielding fund. If the average of the ultra short term or liquid fund return on a 1 year basis or 6 month basis is 7%, then if there is a fund which is yielding 9%, which has given 9%, don't chase the best performing fund, because the reason why it will be yielding higher is that it will be assuming some risk, and risk visits you infrequently, and when you are faced with that risk, you are unable to reconcile with it, or it looks like a big deal, and in particularly in fixed income, your idea should be to optimize your return, have the liquidity, earn 7.5%, not that 9%, because that 1.5% more return will come with disproportionate risk. All the funds, because what I could actually make out from the funds which have this security and they were faced with a decline, all had a slightly higher exposure to this, they were just trying to maximize the return. So that's one. The other is that make sure that none of these just if you're glancing through the portfolio, make sure that it is no more than 2%. So you buy mutual fund for basic convenience of diversification, and if that diversification is not there, avoid that.
Okay, so you need to choose a portfolio with high rated instruments. Is that
high rated instrument? Of course,
understanding right?
Yes, one is higher. Make sure that you're not buying a fund with plenty of lower rated papers. But mutual fund, generally speaking, they are mostly, because this particular instance was a situation where it was which was a high rated paper anyway. It just slipped into a default grade, and so I think the blame lies with the credit rating agencies.
Okay, so your portfolio should be well diversified
and lower component into lower, small component into lower rated papers.
So what Dhiren is saying is that you don't need to panic and stay invested.
Yes.
Okay. We move on to the second part of our Investors Hangout, where we take your questions. And the first question today is from Rao. He says, which category of mutual funds would you suggest in the current scenario when the markets are being so volatile?
Markets are always volatile. Just that when the markets are volatile and on their way up, we don't dislike it. Right now, they are volatile and they're going down, so we don't like it. But I don't think, irrespective of the markets are like this only, and they will always be volatile. The way to deal with it is, if you are getting nervous with the volatility, be with an asset allocation fund. As I keep in, I actually sound like a stuck record. That
no,
if but don't invest in an equity fund for your long-term money. If you are getting started, and you are extremely conservative investor moving from fixed deposit and investing in market for the first time, make sure you do two things: invest in equity income fund, and don't invest all your money at one go. If you have been used to the market a little bit and you are getting upset with the wild, the madness of the market right now, the decline in value of equity in the short period of time, invest in a balanced fund. They will be able to protect the downside. They will also be able to participate as and when the markets turn around. Markets turn around when you least expect it. They always give you a surprise. They fall when you never expect that, what's going on, why it happened. And they will turn around when you least expect it, and it will come with as a surprise. You will not get an opportunity to re-enter. Balanced fund will give you an upside as well as provide you a relatively more stable journey or investment journey. And so ultra conservative investor, investing for the long run, equity income fund. Other investors, balanced fund. It's not a compromise, and that's the way to be. Maybe you can invest for a lifetime in equity through these vehicles.
Okay, that's the mantra.
Yeah.
Okay. DP Singh writes in, my PPF account is going to mature in 3 years. Would it not be better to invest in PPF than debt mutual funds as they are more safe and rewarding? I think his question is more based on this current scenario.
I would address it differently.
Okay.
I would say that yes, if this is going to be long-term money, and every investor should have fixed income. The way we are saying that why you should have a balanced fund is that 1/3 of your money is in fixed income. Maybe investors can look at their overall asset allocation. If you have 15 lakh rupees or if you have 10 lakh rupees of investment, and if this PPF account is 3 lakh rupees, or if you have 50 lakh rupees and 15 lakh rupees is PPF, think of it as a fixed income option.
Okay.
PPF is a good vehicle if you look at it as a fixed income, because the return from PPF is tax free. It definitely is safe, but if it is all that you have, then it is not a wise thing. All your investments completely in PPF, it will get you 8.5%. It will not be able to beat inflation by a wide margin. Sometimes it might by 0.5%, whatever, but it will not make you wealthy. So PPF is a good fixed income avenue for your fixed income allocation. Every investor should have fixed income, whether it be 20%, 50%, or depends. But and as a fixed income vehicle, it's nice based on its return as well as tax efficiency.
Okay. Ritesh writes in, what would be the best withdrawal strategy for a corpus of 30 lakh rupees?
It's not for me to suggest. It depends on two things. How negotiable is your goal?
Okay.
If you need your money 2 years from now for a non-negotiable goal, that much money you should start you should start withdrawing 18 months before you need the money. Exactly the way you do a SIP, you should do a reverse of it.
Okay.
30 lakh rupees and you need 6 lakh rupees after 1.5 years. Start taking that money out every month and put that money in a fixed income fund. So you would have protected, despite all the noise around fixed income fund, they haven't gone down in value of any meaningful kind that it can impair your capital.
Yeah.
It went down by 0.5%, and then it has recovered in another 20 days time. But people were not used to it, so put that money.
They never expected it to go
so
down.
You just be methodical about it. It depends on your goal, negotiability, and the time period.
Okay. And if, as you say, your objective is to say buy something, so therefore, you should withdraw according to that.
Yeah.
But what if it is, say, pension?
Yeah, that requires a different thing. That requires a completely different approach. If 30 lakh rupee is your retirement corpus, then you need to work on some kind of withdrawal strategy so that your money should be invested in a manner that it is growing nicely. At least it is beating inflation, and you should withdraw the money in such a manner that your capital doesn't go down in value in real terms. Okay. Because if you have 10 lakh rupee today and 10 lakh rupee 5 years from now, they are not the same. That 10 lakh rupee 5 years from now will be lower. Right. So you have to withdraw money so that the real value of your money doesn't go down. What is the kind of withdrawal rate that you can have? I think if your money is in a balanced fund, I think 6 to 7% withdrawal rate will likely not impair your capital. If you are invested in an equity income fund, equity savings fund, then maybe a 4 to 5% withdrawal rate will be good enough to protect the worth of your capital as well as support you with an income. Maybe with a turnaround in the market, you will get an opportunity to increase your income, because if your capital goes up, make sure that you are withdrawing no more than 4 to 6% of your capital to protect the worth of your capital.
Okay. The next question is from TP Singh. I invested rupees 3 lakhs in a medium duration debt fund just before IL&FS crisis. Will my investment be safe and give appropriate returns?
Yes, it depends, which fund he is referring to, but I'll say that, if you are invested for 3 to 6 months, it will just lower your return. It is not that your capital will go down in value. And anyway, most investors can't do anything about it. When this crisis happened, the impact on the NAV happened on that day evening's NAV itself. So running away post-crisis, and nobody could anticipate it beforehand. Nobody could have said that take your money a day before or a few days before this happened. So it happened as it was a surprise, it was an accident, and it was a surprise. The effect was visible in that day's NAV itself, so you couldn't do anything but wait. Taking your money out would have made your losses permanent. So holding on to your investments and for the desired time frame. This crisis is being talked about in a big way, but it is unlikely to impair your. It has just lowered your return. If you would have earned 8.5%, maybe you'll be paying 8.25% or 0.5% less.
Okay. I parked funds in 2 ultra short duration schemes of different fund houses to set up a systematic transfer plan into equity funds, writes Hardik. Unfortunately, both these short duration funds are giving poor returns due to the downgrade of ILFS bonds. Should I redeem my money and instead opt for SIP in the equity funds?
You can well do that, but your money may not have gone down in value by any substantial. When equity, stock market drags your investment return in the short run by 2%, 5%. Sometimes we have seen that even in a day the market goes down by 2%. This ILFS bond default and the whole crisis has not translated into that big a problem. Yes, there have been funds which went down in value more, but most other funds were not hit that hard. And in equity, the decline in value is a fairly routine thing. 2%, 5% up and down is a very normal thing in a week's time. Not so in fixed income. The whole idea of investing in equity in a staggered way is to eliminate the possibility of catching a market high. And that you are well succeeding. Look at this as an accident. It has already happened. Taking your money out, putting it in your bank, and then doing your SIP from there will not reduce your pain at all. So just live with it. Maybe you will have some recovery which will get reflected in the fund, even in the fixed income fund.
Okay. So continue doing
what you're doing.
Mahendra has written to us therein, and he writes, I'm invested in a credit risk fund which is performing poorly. It is not even giving 6% return and has been rated as 1 star on your website. However, I have not completed 3 years yet and liable to short-term capital gains tax if I redeem them now. Should I exit or wait for 3 years to complete? I am in 30% tax bracket.
If you are close to 3 years, then wait. If you are done with your 2.5 year or 2 years and more, then wait, because the tax efficiency, 6% return, and that being added to if it's a large sum of money, and 6% for 2 years. It will be substantial. All the income, all the return will be treated as your income. So if it's a crore of rupees, and if you have earned 6% of over the past 2 years, so it will be 12 lakh rupee income added, and on which you run in 30% tax bracket. So this will amount to 3.6 lakh rupees worth of a tax bill. So it depends how close you are to completing 3 years, so that you are able to get the indexation benefit. And 6%, yes, I think these returns, if these, I'm not sure which fund you were invested in, but some of these funds, if they were if they held ILNFS bonds, and if there is some resolution, that might be right back, because the way mutual funds are designed, that the moment such accident happens, the value decline happens that day itself. The fund company is supposed to write it off on their books immediately. So investors find that a big blow that day itself. But if something happens, a part of the capital comes back, somebody else buys it at a discount, then a good part of the money can come back too.
Okay. Gina has written, the value of my equity portfolio in both stocks and mutual funds is deteriorating. I'm a senior citizen and depend on income through the same. What should I do?
You need to really see that, how badly dependent you are on this. And if your 6% or 7% withdrawal rate,
it goes back to what you mentioned.
What I was mentioning, that making sure, and the kind of funds you are invested in, because if you are invested in the small cap fund, mid cap fund, which are witnessing a big decline, and they have already witnessed the big decline. So this kind of investment for this goal requires careful planning. It also depends when did you invest, because if you invested just about a year ago and all at one go, it might be alarming. So consult a financial planner.
I think we should ask our viewers to give us more details about the way
that will be helpful, because how much money invested, how much are you withdrawing, and how much is what kind of capital impairment will translate into difficulty for you.
So details of your investment should be given to us. Ronald writes, I have a corpus of 60 lakhs which I wish to invest in debt funds only. I have a time frame of 3 to 5 years. Since this is my VRS money, I am looking for capital preservation with a return of 8 to 9%. Which category should I invest in?
Consider fixed maturity plans. These are almost like fixed deposit. They have a term of over 3 years. They will be tax efficient. Even if you are able to return, even if you are able to derive return as much as fixed deposit from a mutual fund, that will translate into more, because it will not be, a post indexation. You may not be liable for any taxes. So fixed maturity plans or ultra short term bond fund or short term bond fund, these are your options. Don't try and maximize your return. The kind of money that it is, and the kind of dependence you will have on this, it is better to err on the side of caution.
Okay, I hope you've noted the advice given by Dhirendra, and that's all we have in today's Investors Hangout. But the crux of the matter is stay invested and do not panic at all. Okay?
Yep.
Is that what you would advise?
It's much easier said when you see that investment with an expectation that it will never go down in value. It goes down by 0.5%, but you never expected it. So it causes panic.
Okay.
Far easier said.
I know. Thank you so much for joining us. It's bye from Dhirendra and me, Rajesh Lake. Bye for now.